What people actually do to become millionaires in 2026. For most people, the word millionaire still carries a very specific image. It suggests luxury houses, sports cars, early retirement, and a life that looks dramatically different from the average person's routine. But when economists and financial researchers examine the actual data behind new millionaires in the modern economy, the picture looks much quieter, slower, and far more structured than the popular imagination suggests. In 2026, the people who are reaching the million-dollar mark are rarely doing it through sudden breakthroughs or explosive moments of luck. Instead, what shows up repeatedly in financial data is a set of long-term systems that gradually change how money behaves over time. One of the most surprising realities is that many new millionaires do not start with extraordinary incomes. In fact, studies from long-running wealth surveys often show that a large percentage of millionaires spent decades in relatively ordinary professions. Teachers, engineers, managers, small business owners, medical technicians, and accountants appear frequently in these reports. What separates them is not usually a single dramatic opportunity, but rather the consistent construction of financial systems that slowly redirect income toward assets instead of consumption. To understand what people actually do to become millionaires, it helps to start with a simple psychological shift. Most individuals initially think about money as something that moves through their life in a straight line. Income arrives, expenses follow, and whatever remains becomes savings. This framework makes wealth accumulation feel slow and uncertain because the majority of financial decisions revolve around spending choices. But individuals who eventually reach higher wealth thresholds often reverse that structure. Instead of treating savings as the leftover portion of income, they treat asset accumulation as the first destination for money as it enters their system. This change might sound subtle, but mathematically it alters the entire trajectory of long-term financial growth. Consider two people with identical incomes. If one person consistently allocates a fixed portion of income toward investments before adjusting lifestyle spending, while the other waits to see what remains at the end of the month, the outcomes diverge slowly at first and then dramatically over time. The reason for this divergence lies in compound growth, a mechanism that quietly amplifies small financial differences across decades. Compound growth works by allowing returns to generate their own returns. When money is invested into assets such as diversified funds, business equity, or productive capital, the growth does not simply accumulate in a linear way. Instead, each year's growth becomes part of the base that generates the following year's growth. This means the first years of investing often appear slow and unremarkable. The numbers increase gradually, and the psychological reward feels minimal. But once the base becomes large enough, the growth begins to accelerate without any additional effort from the individual. This delayed acceleration is one of the reasons wealth accumulation often feels invisible from the outside. When someone crosses the million-dollar mark, observers sometimes assume that a dramatic financial breakthrough must have occurred recently. In reality, the system responsible for that outcome may have been operating quietly for 20 or 30 years. The visible milestone simply represents the moment when compounding finally becomes large enough to be noticed. Another pattern visible among many modern millionaires is the gradual expansion of income sources rather than reliance on a single salary. This does not necessarily mean launching large businesses or engaging in high-risk ventures. In many cases, it simply involves developing multiple streams of productive capital over time. Rental properties, small equity stakes in businesses, dividend-paying investments, intellectual property, or long-term index funds can all function as additional financial engines that operate alongside earned income. From a mathematical perspective, multiple income streams reduce dependency on the linear relationship between work and earnings. When income originates from several different sources, financial growth becomes less sensitive to disruptions in any single area. This structural stability often allows individuals to continue investing even during periods when employment income fluctuates, which in turn keeps the compounding system running uninterrupted. Behavioral economists also observe that many individuals who eventually reach high wealth levels adopt extremely consistent spending behavior long before their net worth becomes large. This does not necessarily involve extreme frugality or deprivation, but rather the avoidance of rapid lifestyle expansion when income increases. When earnings grow, the difference between income and spending widens rather than disappearing into higher consumption. This widening gap is crucial because it feeds additional capital into the compounding system. A raise, bonus, or side income becomes new investment fuel rather than simply increasing monthly expenses. Over long time horizons, this pattern allows wealth to accumulate faster than lifestyle expectations, creating a financial buffer that continues to grow even as personal spending gradually increases. In 2026, technology has also quietly changed the way people build wealth systems. Automated investing platforms, digital brokerage accounts, and algorithmic portfolio management tools allow individuals to create structured investment plans with far lower friction than previous generations faced. Decades ago, investing regularly required significant paperwork, broker interactions, and higher transaction costs. Today, many individuals automate the entire process so that capital moves into investments automatically each month without requiring repeated decisions. This automation plays a psychological role. When investing becomes automatic, it removes the emotional friction associated with market volatility or short-term financial uncertainty. Instead of reacting to daily news cycles or temporary market movements, the system continues operating in the background. Over time, this consistency becomes more valuable than any attempt to predict short-term financial events. Historical data reinforces the importance of this long-term consistency. When researchers analyze periods of economic instability such as recessions, inflationary cycles, or financial crises, they often find that individuals who maintain steady investment behavior across multiple decades experience outcomes that are far more stable than expected. The reason for this is that market volatility, while uncomfortable in the short term, often provides opportunities for additional capital to enter assets at lower prices, which strengthens long-term compounding. Another factor that appears repeatedly in the financial profiles of many millionaires is patience with slow progress. Early in the wealth-building process, the numbers can feel discouragingly small. A portfolio growing from $10,000 to $12,000 may not appear life-changing. However, the mathematics of compounding means that each stage builds the foundation for the next stage. The growth that appears modest in the beginning eventually supports much larger numerical changes later. This is why wealth accumulation rarely feels dramatic while it is happening. For many years, the financial system operates quietly beneath the surface of everyday life. Investments grow slowly, income streams expand gradually, and spending habits remain controlled. But as the capital base grows, the compounding effect becomes stronger and stronger, eventually reaching a point where annual growth alone can equal what once took years of saving to achieve. From the outside, that moment can look like a sudden transformation. In reality, it's simply the visible phase of a system that has been operating patiently for a long time. So, when people ask what people actually do to become millionaires in the modern economy, the answer rarely involves a single breakthrough event. Instead, the pattern that appears again and again is the quiet construction of financial systems designed to redirect income into assets, maintain consistent investing behavior, and allow compound growth to operate across long stretches of time. The process is not fast, and it's rarely exciting to observe year by year, but over decades, the mathematics behind these systems gradually reshapes the financial trajectory of the people who follow them. By the time the million-dollar threshold appears, the real work has usually already been done, long before anyone noticed. So, when people ask how millionaires are created in the modern economy, the answer is rarely a dramatic breakthrough. More often, it is the quiet result of systems repeated over long periods of time, small financial decisions that slowly reshape the trajectory of a life. If you enjoy exploring the psychology and hidden mechanics behind money and economic systems, consider subscribing to the channel. New videos every week.